Hi, I'm Lorna Illingsworth, an independent financial advisor for Protection Investment Southampton. Today we're going to discuss what happens at the end of an interest-only mortgage. If you have an interest-only mortgage, the monthly payments can feel much more manageable because you are only paying the interest charged on the loan rather than paying back the balance itself. But eventually that balance still needs to be repaid. Many borrowers reach the end of the mortgage term and wonder what happens next, what options they have and whether they need to act now. With an interest-only mortgage, your monthly payments cover the interest charged by the lender, but they do not reduce the original amount you borrowed. That means if you borrowed $150,000, you could still owe $150,000 at the end of the mortgage term. Some people take interest-only mortgages for the full mortgage term, while others may have a part repayment and part interest-only arrangement. Either way, when the term ends, the remaining balance needs to be cleared. When the mortgage term finishes, the lender will expect the outstanding mortgage balance to be repaid. If no action has been taken beforehand, this can create pressure and uncertainty. That is why it's important to review your mortgage well before the end date, ideally many months or years in advance. Leaving it too late can reduce your options. Some borrowers plan from the beginning to repay the mortgage using savings, investments, pensions, ISAs, endowments or other assets. If those funds have performed well and are available when needed, they may be used to clear the mortgage balance. However, it is important to check whether the amount available is enough, as investment values can rise or fall. Another common option is to sell the property and use the proceeds to repay the mortgage. If the home has increased in value over time, there may still be money left after the mortgage has been repaid. Some borrowers use this opportunity to downsize to a smaller property or move to a more suitable home. However, this depends on property value, selling costs, and whether there is enough equity available. Some borrowers choose to refinance onto a repayment mortgage. This means taking out a new mortgage, gradually paying back both the balance and interest over an agreed term. This can work well for borrowers who still have sufficient income and meet lender affordability checks. But monthly payments are usually higher than on an interest-only basis because you are now repaying the capital as well. Borrowers over 50 often worry that getting a new mortgage may be more difficult. While age can affect lender criteria, many lenders now offer later life lending products designed for borrowers approaching or in retirement. The lender will usually assess pension income, other assets, affordability, and how the mortgage would be repaid in future. This is why professional advice can be especially valuable for older borrowers reviewing their options. For some homeowners aged 55 and over, equity release may be considered. This allows you to access money tied up in your home, often to repay an existing mortgage. It is not suitable for everyone and can affect inheritance, future options, and the value of your estate. Because of this, equity release should always involve specialist regulated advice. If you're concerned that you may not be able to repay the balance, it is important to speak to your lender early. Possible options may include extending the mortgage term, switching part of the loan to repayment, refinancing elsewhere, or agreeing a new arrangement. Ignoring the issue is usually the worst option. If no solution is found, the lender could begin repossession action, so early advice is essential. Ideally, borrowers should review their options at least 6 to 12 months before the mortgage ends. This gives time to assess affordability, compare lenders, gather paperwork, and make decisions without unnecessary pressure. The earlier you act, the more options you are likely to have. The end of an interest-only mortgage does not need to be a crisis, but it does need planning. Whether the right solution is selling, remortgaging, using savings, or exploring later life lending, the key is acting early and understanding your choices. If you would like help reviewing your options, speaking to an experienced mortgage advisor can make the process much clearer. you have an interest-only mortgage and would like to discuss your options, please call us on 02380 668 407 or visit our website.